The US-China trade war has crashed many Chinese stocks, which has opened up many Chinese stocks into buying points. I believe that the US-China trade war will end soon, as Trump will want to have the trade deal finished or have the tariffs suspended by the time the 2020 elections roll by in order to gain the most amount of votes. With that being said, there are many obvious buys right now, including Alibaba, Tencent, JD.com, and Baidu. But today I'm going to avoid these stocks because you guys probably already know about them, and I'm going to start talking about Chinese stocks you may have never heard of before, but nonetheless, they're still buys. The first stock on this list is Baozun, which has a ticker symbol of BZUN. Baozun is an e-commerce business partner that partners up with foreign companies from America, Japan, and many other foreign companies that aren't familiar with China's market. Some major brands that they are partnered with include the NBA, Microsoft, Toyota, Levi's, Calvin Klein, Nike, and so many more brands like GoPro, GNC, Philips, and Huawei. The list goes on forever, and I'll leave a link in the description below if you want a full list of all the companies Baozun is partnered with. Now, despite the drop in the majority of Chinese stocks, including Baozun, Baozun still trades at a premium compared to its sector median, as its PE ratio is at 61 versus the sector median of 17. However, when we take a look at Baozun's forward PE ratio, the game changes, as its forward PE ratio sits at 34 versus the sector median of 17. This is due to Baozun's incredible growth, as its revenue grows 26% year over year right now versus the sector median of just 4% year over year. And as if that is not enough, it's still expected to grow 27% year over year in the future, which is still far higher than the sector median of close to 4% year over year. To top it off, its EPS diluted growth is at 33% year over year, and it's still expected to grow 52% year over year in the future. Again, much higher than the sector median of 9% year over year. For this reason alone, Baozun's 61 PE ratio is not concerning, as it's a growth stock that's actually much lower than what it usually trades at compared to its history. When it comes to liabilities, Baozun has $260 million in total liabilities, which is not too much considering that it has $74 million worth of cash and short-term investments that it can use to pay off these liabilities if needed. Overall, analysts are very bullish on Baozun due to their tremendous growth rates. The average analyst rating is at Outperform, which is a rating of 4.11 out of 5. Along with that, the average price target is at $47, which is a decent upside to the current price of $43. As a result, Baozun is a great growth stock that offers a nice discount right now due to the US and China trade war. Now let's move on to the second stock on this list, Ctrip.com, which is a ticker symbol of CTRP. Ctrip.com has been absolutely hammered recently in the trade war, as it's down around 23% since its monthly highs earlier. Ctrip is the leading travel agency in China that helps with ticketing, reservations, packaging, and managing travels. When it comes to value, Ctrip is not as absurd as Baozun, as its PE ratio is at 29 versus a sector median of 17, while its forward PE ratio, which is much more intriguing, is at 20 versus a sector median of 17. Now, of course, this is again due to their fast growth rates, as they're currently growing 10% year over year and is still expected to grow 14% year over year in the future, far higher than the sector median growth rate of 4% year over year. Similar to Baozun, analysts are pretty bullish on the stock, as the average rating is at Outperform, which is a rating of 4.08 out of 5, and their target price is at 44 versus the current price of 36, which is a huge upside. Now this business is actually much larger than Baozun, which explains the inflated balance sheet here, as they have a huge amount of liabilities that totals up to $10 billion short-term and $14 billion long-term. but they also have a massive amount of cash and investments at $8.47 billion. The stock price of Ctrip.com moves in waves of up and downs, so I'd wait for a confirmation of an uptrend before investing. Just a side note, they may start going to an uptrend very soon. Let's move on to the second to last stock on this list. It's second to last because I actually have an honorable mention at the end. This third stock is extremely risky, but can potentially offer huge rewards. This is Huya, which surprisingly has the same ticker symbol as its name, HUYA. Huya is often called the Twitch of China, as it is a gaming video and streaming company that has two competitors, Douyu and Panda TV, which are also Twitches of China. These companies thrive in China because they're essentially a copy of Twitch, and Twitch is actually banned in China. Therefore, these are the companies that take over Twitch's market in China. The reason why Huya is such a high risk stock is because of its insane growth rates. We're talking about growth rates far higher than Baozun and Ctrip.com. Huya's growth rate on revenue is currently at 93% year over year versus the sector median of 1%, and is still expected to grow close to 60% year over year in the future, which is still far higher than the sector median of 4% year over year. Now, they are a profitable company, but they actually have no trailing PE ratio, so all we have left is the forward PE ratio, which is absolutely insane at 98 versus a sector median of 23. If you take a look at Huya's earnings growth rate, we see that this company is growing at an insanely fast rate. We're talking hundreds of percents of growth. This company has dropped 21% from the monthly highs due to the US and China trade war. It was actually previously an IPO bubble that at first shot up 187%, but is now down 52% since then, so they might be starting to consolidate at a fair value soon. If you're looking into these types of risky stocks, Huya may be the stock for you. Now, Huya is actually owned by a company called YY, which is actually the next stock on this list, the honorable mention, YY Incorporated. This stock was actually requested by a viewer, GC, so if you guys have any stocks you want me to talk about, just leave them in the comment section below. So, I actually love this company right now due to their low valuation, as their PE ratio sits at 8 versus a sector median of 19, while the forward PE ratio is at 10 versus a sector median of 23. The reason for such a low valuation is due to their attempt to increase revenue growth, which is currently growing 28% year over year versus the sector median of 1%, and is still expected to grow 33% year over year in the future. However, due to this, their EPS growth is actually expected to decrease in the short term, but in the long term, this could be a great investment. That is why I am leaving this stock as an honorable mention. It could be a great investment for the long term, as it has high risk and high reward. I won't pull the trigger on the stock yet because I believe it could go lower in the short term, as it's struggling to profit right now. If you guys enjoyed this video, please subscribe, like, and comment. I really appreciate your guys' help with my channel. It seriously helps out a lot. Thank you guys for watching.